So let's get straight into the candlesticks. I'm going to be going over some bullish and bearish signs in the regular candlesticks. And in just a moment, I'll be sharing the Heikin-Ashi candlesticks and why the Heikin-Ashi candlesticks can act as a valuable indicator within our trading strategy. So no matter what candlesticks you're looking at, whether it's the regular candlesticks or the Heikin-Ashi candlesticks, on a single chart like this, all candlesticks are equal time periods to each other. So for example, this is the daily time frame. So each one of these candles is one entire day, and that does not change whether we're looking at the regular candlesticks or the Heikin-Ashi. But of course, we can come up here in the top left and change the time frame, but that changes the time frame for all candlesticks on the chart. So for example, if we went to the 1 hour chart, then each one of these candles is just 1 hour. And just starting off with some basic definitions. First of all, the green candles mean that the closing price for that time period was higher than the opening price, and the red candles mean the exact opposite. So the closing price was lower than the opening price when we're looking at a red candle. And so the opening price is simply determined by the price of an asset such as Bitcoin, for example, at the time of that new candlestick beginning. So for example, when we're on the daily time frame, when it hits midnight UTC, that is when one daily candle closes and the next one opens. And so once again, the open price is simply the price at the beginning of the day, and that goes off UTC time. And then the closing price is of course the price at the end of the day. And the price action between the opening price and the closing price is known as the candle body, but quite often we experience price action that is outside of the candle body. And that price action is shown by these really thin lines on the candlestick, and those specific parts of the candlesticks are called the candle wicks, and they can be to the downside or to the upside. So the very bottom of a candle wick is the lowest that the price reached in that particular day. For example, we're on the daily time frame, but if we're on, let's just say, the 1 hour time frame, then the bottom of the candle wick is the lowest that the price got to within that time frame that we're looking at. And then for the top of the wick, it's the exact opposite. It's the highest point that the price reached within that time period. So this is exactly why candlesticks are so much more valuable than just a regular line chart, because candlesticks provide 4 pieces of information. And just quickly recapping the 4 pieces of information that the candlesticks show us, we have the opening price in a particular time period, the closing price in a particular time period, and then we have the lowest price in that specific time period and the highest price in that specific time period. But up the top here, when you're switching to the line chart, that simply just shows you one piece of information, which is only the closing price for a specific time period. So looking at the basic line chart, we don't even know the lowest or the highest point in a particular time period, because this line is only determined by the closing price of each of these time periods. So just quickly switching back to the regular candlesticks, that is why it's really important to understand candlesticks and really get familiar with them, because in the long term, they will provide much more value to you than just a regular line chart. And when it comes to candlestick analysis, honestly, if I were to fit everything in, that would need an entire section of this course just dedicated to candlestick analysis, because there is so many different types of candles to cover, and every single candle has its own separate meaning, and that is only scratching the surface, because then we enter candle clusters that might be a candlestick pattern that could contain 3 candlesticks in a certain formation. So honestly, if I were to do a deep dive into candlestick analysis, I would likely need to have to make a whole nother course talking about that. So I'm only going to briefly talk about the main things to know when it comes to candlestick analysis, and I'll show you what I look for before placing a trade. So first of all, the wicks are honestly one of the most underrated part of the candle, because the candle wicks can tell us a lot about the candle. For example, if the price crashes to the downside, if we have a giant candle wick to the downside, then that means that there is a lot of buyers in that region for at least that time period. So a huge candle wick like this can tell us that this area on the chart is major support for the price, at least in the shorter term. Obviously, we can head lower later on, but most of the time, if we see a major candle wick like that, we hold above those sort of levels for a decent amount of time. And the same thing goes for if we see a major candle wick to the upside, that shows that there is a lot of selling pressure in that area on the chart for at least that specific time period, which basically means that there is a lot of resistance in that area on the chart, and it's unlikely that we're going to break above that area very quickly. And in this case, after we saw that huge candle wick to the upside, the price action had a very harsh rejection to the downside, and then the price action formed a significant wick to the downside, which acted as the support range for the price action later on. And now talking about the candle bodies, as I discussed in section 2 of the course, the candle closes in particular can be used to confirm a break of a significant level. So using this as an example, quite often we might see wicks on the other side of a significant line of support in this case, and then when that's flipped into resistance, we might see wicks to the upside above a significance line. But unless we see a candle close on the other side of that significance significant line, then that line is not officially broken. And when you're tying this in with those candle wicks, this can be very useful because once again, when we're seeing candle wicks, especially on the other side of support, while the candle closes are still above the support line, this can be a buy signal showing you that there's a lot of buying demand at these lower prices. And on the flip side, this can also be a sell signal as the price is running into resistance, and if we are not seeing any candle closes above that resistance, but we're getting some major wicks to the upside, that can often prove to be a great sell signal or a signal to enter a short position. Now taking a look at the Heikin-Ashi candles, which means average bar in Japanese. And this Japanese candlestick chart basically just filters out the market noise so that we can see trends a lot easier. And the reason behind the Heikin-Ashi name is, once again, it's Japanese for average bar, and it is named that because of how they are calculated. With the regular candlesticks, the open is equal to the previous candle close, because of course, when we're switching from one day to another at midnight, that switch happens instantly. So on regular candles, the close of one candle and the open of the next candle is basically at the same price on regular candlesticks. But zooming in a little bit closer on Heikin-Ashi candles, we see that that is not the case. The Heikin-Ashi candles still use the same highs and the same lows on the candle wicks, so the high and the low points are not changed whether you're looking at the regular candles or the Heikin-Ashi candles. The difference is how the open and the closes are calculated. So when you're looking at Heikin-Ashi candles, the open is calculated by the average price of the previous candle body. So it takes the open of the previous candle and the close of the previous candle, and when you add those two values together and divide them by 2, so once again taking the average between the open and the close of the previous candle, that determines the open of the next candle. So the candle opens are basically in the middle of the previous candle bodies, but the Heikin-Ashi candle closes, on the other hand, are calculated by taking the average between the open, the low, the close, and the high. So just to explain the close in another way, it takes the open price, the lowest price, the highest price, and the closing price, and adds all 4 of those values together and divides it by 4 to get the average price, and that determines the candle close. And by doing that, we get these very nice movements in the Heikin-Ashi candles, which clearly display the price trend. So in most cases, when we're seeing green in the Heikin-Ashi candles, it's very likely that we're going to continue in the green for quite some time. That's not always the case, but the Heikin-Ashi candles are at least better than the regular candlesticks at spotting trends and also at determining the strength of a trend. Because what you'll notice here in the Heikin-Ashi candles is that when the price is in a strong uptrend, there is pretty much no candle wicks to the downside. And it's the exact opposite if we're in a strong downtrend. There's no candle wicks to the upside in a strong downtrend in the Heikin-Ashi candles. So anytime you see a bullish formation like this in the Heikin-Ashi candles, where there's basically no wicks to the downside, then it's very risky to be going short and it's very profitable to be in a long position. And then the moment we start getting some wicks to the downside, and especially after we start getting some red Heikin-Ashi candles, then that is how we know that the uptrend is likely coming to an end. And then the moments that we start forming some red Heikin-Ashi candles with almost no wick to the upside, that alone can almost give us a signal to just go into a short position. But of course, as I've mentioned a lot throughout this course so far, we're looking for confluence not only across these candlesticks, but also across different indicators, chart patterns, support and resistance. And so all of this comes together in making a decision whether to go long or short at any given time. And now talking about risk management, this is one of the most important topics in this entire course, because no matter how good your trades are, it's basically guaranteed that every now and again you're going to have a losing trade, because there is absolutely no trader in the world that can hold a 100% win streak in the long term. That's just simply unrealistic to expect anything close to that. The majority of traders that I know are very happy if they can get a 70 to 80% win streak, which basically means out of 10 trades that you're taking, around 2 or 3 of them might be losing trades, and the other 7 to 8 of them are winning trades. And so because of that fact, when eventually those losing trades come around, it's very important that you are not losing more than you can afford to lose. And obviously everyone's risk appetite is completely different. So if I told you the exact amount of risk that I normally take on my trades, that might be way too risky for some of you, and for others, that might not even be risky enough. But anyway, the first thing to know about my risk management strategy is the fact that I only normally risk around 0.1 to 0.2% of my entire portfolio on any given trade. And at all times, I am risking less than 0.25% of my entire portfolio on any given trade. So in the worst case scenario, I am only losing around 0.2% of my entire portfolio if a trade completely does not go to plan. So by doing that, I can make over 5 losing losing trades in a row and still lose only around 1% of my entire portfolio. Another important part of my risk management strategy is the fact that I know all of my entry and exit prices in any given trade before I take the trade. This is something very important to know about your trades, and in fact, one of the biggest mistakes that the beginners make. I see a lot of beginners just enter a random long position or short position with no idea where they're going to take profits, and by doing that, you're always asking to lose money. Let's just say here, for example, if we set up a Fibonacci retracement and we place a short position at the golden pocket, even as the price is heading to the upside here, I would already know at this stage that around the golden pocket area, around this price area, is the price that I'll be willing to enter into a short position. And if the price doesn't make it all the way up there, then that is okay. I will be patient in the market and wait for the next opportunity. If the entry is not a great entry, if we only turn around here, then I simply do not enter. I would rather be in no trade than be in a trade that is at a higher risk of losing money. And once again, before we even enter into the trade, we need to know the area on the charts where we would be willing to take some profits out of that trade. Because in all trades that I take, I go over to this left side in the tool menu and use these two tools just here, the long position tool and the short position tool. For this example, let's use the short position tool and put that here on the chart. Every single one of the trades that I take has at least a 2-to-1 risk to reward ratio. So if we're dragging the middle line just here to our entry price, and then let's just draw out another Fibonacci retracement tool, and let's just say we'll take profits at around the golden pocket here. So we drag down the bottom of this short position tool just like that, and I'll get rid of some of these Fibonacci lines so it clears things up a little bit. And then taking a look at our stop loss, I'll bring that down to a point where we're at least a 2-to-1 risk to reward ratio, but ideally we like to have our stop loss on the other side of a significant line. So for example, here is the 78.6% Fibonacci level. If we have the stop loss just above that level, even if the price breaks above the golden pocket, there's still a chance that we could get rejected from the 78.6% Fibonacci level and come back to the downside. But if we broke above this final Fibonacci level, then it is more likely that it would continue heading higher. And in that case, it's just better if we take a loss and close that trade. But if we're entering here and we have another significant line on the chart like this 78.6% Fibonacci level, one of the worst things to do is have a stop loss that is too tight to your entry price, because in that case, we could have a quick wick to the upside that would stop you out of that trade. And then the price might get that rejection from the 78.6% Fibonacci level and start heading to the downside again. And now using the long position tool, placing this horizontal line just here, what we can know so far is that the price has found a lot of support along this horizontal line of support. So first of all, you do not want to be longing in a downtrend, but just for this example, let's just say you entered a long position as the price bounced along this support level, and I'll just get rid of the previous drawings on the chart so they're not in the way. Remember, as the price is heading to the downside, if we're planning on entering into a long position, we need to already determine our entry price and a possible exit price as well before even taking that trade. So let's just say we determined the entry price by looking at this huge line of support, and then we might determine the exit price by looking at the golden pocket to the upside. In that case, if we're coming over here and placing that long position tool onto the chart and placing the top of this tool, the price target, to the area where we're actually targeting, and then let's just say we entered this long position over here on this initial bounce in case we actually found support just before this lower level. In this case, remember, we would still keep the stop loss below this significant line that we've already found support along, so that we're a little bit more flexible here. If the price heads a little bit lower, we could still get a bounce from that support, and that would turn out to be okay. We would only get stopped out of the trade if the price breaks that important level of support, and in that case, the price would be heading a lot lower. But right here in this example, we've got a risk to reward ratio of 3.5 approximately, which means that the potential reward is around 3.5 times bigger than what we are risking on this trade. And so when we keep the risk to reward ratio above 2, that means that we could be losing half of our trades and only winning half of our trades. But because we're only taking risk to reward ratios above 2, that means that one of the winning trades at a risk to reward ratio of 2 would pay for 2 losing trades. And it goes without mentioning, we should always be using a stop loss on every single trade that we take, and calculating that stop loss ideally on the other side of a significant line of support in this case, or if we're in a short position, the stop loss would go on the other side of significant resistance. And if that is too far away from your entry price, then that was a bad entry price. Remember, I would only enter into a trade if it is a good entry price to enter, because on a bad entry price, that means that the stop loss would have to be a lot closer, especially if we're using some higher leverage, and that simply increases your risk of losing that trade. So it is very important to remain patient in the market and only take a trade if you are very confident in that trade after seeing a lot of confluence on the chart. chart. And one more valuable tip that I have to you that rapidly increased the amount of winning trades that I had compared to losing trades. And that tip is to simply move my stop loss into profits as the trade goes into profits. Before implementing that tip, a lot of losing trades of mine actually were in profits at one point during the trade. For example, if we're in a long position and the trade might not make it all the way to the exact price target and start turning around again. In this case, after the price has gotten above some significant levels on the chart, I would move the stop loss into profits above the entry price, but still below those significant levels on the chart, so that if the price comes back to the downside, we could still possibly get a bounce at those significance levels, keeping us in that trade. But if the price breaks back below those significance levels, then at least we'll be stopped out in some profits. And I've actually made that one of the main goals of mine with every single trade that I take. I like to put my stop loss into profits, so in that way, I'm guaranteeing profits no matter what, and it cannot be a losing trade. But with that being said, of course, it is still important to keep your stop loss a little bit further away from the current price action, because the last thing that you want is keeping your stop loss very, very close to the current price action, and then just a very small move to the downside, stopping you out of a long position, for example. So as I just mentioned, I normally keep my stop loss in a long position below an important area of support. And then in a short position, let's just say if we shorted at that golden pocket right there, as we're moving to the downside here, I would perhaps put my stop loss just on the other side of the golden pocket in case on this next rebound, if we broke through the golden pocket, then it's likely that would head a lot higher. But considering that the golden pocket is huge resistance, it's still more likely that the price would find a rejection from that level, which would be keeping us in that short trade. But having a stop loss just on the other side would mean that we'd still close that trade in profits if we had a good entry point, as we discussed earlier. But that just about wraps up the bonus content for this course. I appreciate you watching all the way to the end, and more importantly, I appreciate your purchase. All purchases go towards funding future projects on the Crypto World channel, and honestly, all of your support is greatly appreciated. And I hope that you got a lot of value out of this course, because I really did try and jam in as much value as I possibly could. But that is now everything that I have to mention in this course, and I really hope to see you soon back on the Crypto World channel.